Hi everyone, it's Jab out another video. Today I'm going to talk about JP Morgan Equity Premium Income ETF, otherwise known as JEPI or JPI. I'm going to call it JEPI. It's flat so far this year pretty much, up 9% in the past 5 years, trailing the market on that basis. Not too exciting really. What is exciting is the dividends. Obviously this is a premium income ETF. It provides excellent dividend. It's currently yielding over 12%. It also pays its dividends monthly, which is something to get very excited about, as it could provide potential income for investors on a regular basis. I'm going to analyse this ETF, look at its top holdings, look at how it generates those fantastic dividends, and see if I think it's an investable ETF. The aim and strategy behind this ETF is really pretty simple. They're aiming for premium income, i.e. an attractive, much higher than average dividend yield, which its 12-month rolling dividend yield was 11.45% as of March. It's now currently above 12, and they're looking for lower than average volatility, lower volatility than the S&P 500, which at the minute is succeeding. It's also looking to be competitively priced, and which it is competitively priced versus its peers at just 3.5% expense ratio, not objectively cheap when comparing it to, say, Vanguard S&P index fund, but cheap enough in my opinion versus other actively managed funds. It has 2 portfolio managers with a combined 60 years experience in equities and equity derivatives, and it has a defensive equity portfolio in the 1 to 2% dividend yield range, which I think are mostly quality companies. As the most recent data I could find, these are the top 10 holdings of this ETF in order. Again, all of these below 2% of net assets, so clearly an extremely diversified fund. Hershey's, PepsiCo, Microsoft, MasterCard, Coca-Cola, Progressive, AbbVie, Amazon, Comcast, Visa. Now, excluding Amazon, which is, I'm not exactly sure why that's in there because it doesn't pay a dividend, probably for they're selling a lot of options on this. These are all very defensible, in most cases extremely boring companies, very low volatility, only really AbbVie that's a significantly above average dividend yield. I would consider all these businesses relatively boring, low volatility, safe, many of them dividend aristocrats or dividend kings, and many of them with extremely low dividend yields under that 1%. So clearly investing in majority dividend stocks that yield between 1 and 2%, there's a big difference between the greater than 10% yields they're getting, and that difference is made up from options premiums. It generally does better in high volatility environments because it uses equity-linked notes, which are essentially more complicated covered call options. They sell a contract that gives someone the right to buy a stock at a certain price at a certain time, and they collect a premium for this. And they're approximating this at 5 to 8%. That is what they've been achieving recently. That is because we're in high volatility environments and have been for the last couple of years, where JEPI has performed admirably. And this, in low volatility environments, perhaps they may be delivering less income. They'll always be pretty much guaranteed that 1 to 2% dividend yield because that is the backbone of this portfolio. The options premiums are where you're going to get the outside returns. In lower volatility environments, this is certainly uncertain. However, volatility since the inception of this fund has been significantly below the S&P 500, over 50% less volatile than the S&P 500, which is certainly impressive, and exactly what income investors will be looking for. This was the best chart I could find that illustrates the difference between JEPI's performance in terms of yield versus other typical investment yield chasing investment. Now this is a little out of date because it shows JEPI's dividend yield as 9.59, which on a rolling 12-month basis it's now over 11%, but this gives a decent comparison either way because none of the other asset classes have really moved that much. US equity, so stocks, 1.6%, that is positively meanly compared to JEPI, with probably increased volatility, particularly like the S&P 500. US 10-year bond, 3.5%. This will, again like JEPI, will see little to no appreciation. However, that 3.5% yield is not particularly attractive. Global REITs, 4.5%. REITs have seen the net asset values plummet in some cases, so that 4.5% does not come risk-free by any means. And US high yield, 8.5%. Now compared to JEPI, which again is not risk-free, these look relatively unattractive in my opinion. As I mentioned, one of the main attractions for this business is that it pays monthly dividend with a low volatility for the ETF as a whole. However, the dividend itself has some volatility because the majority of it is made up of options premiums, and that fluctuates with the volatility of the market. The dividends have fluctuated roughly between 40 cents a share and 60 cents a share, with some slightly higher, and that's what I did for the whole of last year. Again, the whole of the last year has been pretty volatile times, some months more volatile than others, but this cannot be expected for future returns if we return to, say, 2016, 2018 levels of the market. Not particularly volatile. We could be seeing dividend yields significantly lower, closer to that 1 or 2% range. Obviously, that's slightly higher if they're doing the job correctly with the options premiums. This chart from JP Morgan illustrates the options premium variability really nicely, in my opinion. As you can see on the left hand side, the 12-month rolling dividend yield for this business is 11.45%, which is obviously absolutely excellent, pretty much best in class in my opinion for this level of volatility. And you can see how little of it is derived, those 1 to 2% dividend yields, and how that does have relatively high variability month to month, but that is to be expected. It's dividends, and it's multiple different companies. Some with very large dividend yields will be declaring at different times. Some with small dividend yields will be declaring at different times. We can see a massive amount of variability with the options premium. You can see some as large as 113 monthly yield in basis points in October, and some as low as 77 in February because of just 65 basis points from options premium. So there's high variability here, and that may be what some people want. Overall, I think this is an excellent option for income investors. Obviously, it's had a really outsized dividend yield the last few years, and last year it did outperform the S&P 500, being down much less than the index. But only really do I think this is a sensible option in really volatile environments. It's not really a passive investment in my opinion. It's not like buying a Vanguard S&P 500 fund. This is a relatively active investment because in my belief, you're investing in the belief that there's going to be some volatility in the markets, and if there's not, you're going to get minimal returns. In terms of appreciation, it's returned just 9% in the past 5, well, not the past 5 years, since 2020, its inception, which is admirable, in line with the S&P 500, better in the last year or so, but not particularly special. And when including the dividend, it has performed admirably, but that's only because we're in volatile environments. In less volatile environments, which I'm hoping there will be in 2024 and beyond, perhaps when interest rates have sorted themselves out a bit and inflation has subsided, is this really going to be a market-beating investment? Probably not. And is the dividend going to be as outsized as it previously was? Probably not. I wouldn't be surprised to see those options premiums half into in the range of 2.5 to 4% plus the dividend. That's 5% yield. That's decent, but we're probably not going to see the same returns as the S&P 500 in a better environment for higher growth companies. So for me, this is an investment for the next 1 to 3 years, and I'd be much happier to move my money into just an S&P 500 index fund or into active investments, because I kind of think this isn't a relatively active investment. But of course, that's just me. For those seeking income in the relatively short term, particularly monthly income, which is quite hard to come by in quality ETFs, I think this is a really good choice. But of course, that's just my opinion. I'm not a financial advisor. You should do your own research and due diligence, not just buy or sell or ignore things just because I say so. And of course, capital is always at risk. Like and subscribe if you enjoyed the video. Let me know what you think of JEPI in the comments down below, whether you think this is an excellent income stock or just another ETF that is likely to be ignored. Whatever you think, let me know in the comments down below. Like and subscribe if you're enjoying. I'll see you again next time.